Time for pizza here. Nothing to hide, nothing to hide. All right, so, starting the day with 19,500. I've been taking my knocks lately. I've been generally short this market because there's a bank crisis brewing, occurring, prelude to it, whatever you want to call it. It's starting and it's rolling, and it's getting stronger, and odds are it's not going to stop, not unless the Fed steps in and does something drastic, which it's not going to do until things actually get ugly. So I've been taking a little bit of a beating. You know, I was hovering around 26,000 earlier in the week. Now I'm at 19.5. It's a pretty big loss. I mean, that's 20% of my bankroll. So, but I am up 1,300 today. So current account value at about 21,000. Good. Why? Because I had some puts overnight and the market opened down. All right, so we are, where do I want to begin here? Let's see. So overnight, Credit Suisse, which was having a run on it in Europe. It's a Swiss bank, by the way. It's not part of the European Union, and it doesn't use euros. It's a Swiss bank, and it uses the Swiss franc. So yesterday, there was a bit of a run on it. Overnight, the Swiss central bank and the Swiss government came out and said they are going to backstop Credit Suisse. And they gave them a 54 billion franc loan overnight. And the franc is basically the dollar. They're almost 1-to-1. So basically a $54 billion bailout for Credit Suisse overnight, which helps. It helps. But Credit Suisse does have $1.4 trillion, or I don't know. I've seen different numbers for the assets under control at Credit Suisse. But it's at least $1 trillion, in that ballpark, maybe a little more. And I mentioned this yesterday, the entire Switzerland GDP is only 800 billion. So, you know, if they're going to backstop the assets of Credit Suisse, they really can't. Switzerland isn't capable of doing that. You know, and giving them $54 billion is, what is that? That's 1/16 of their annual GDP. So, you know, you've just given them 7% of your annual GDP in a bailout. I wonder how the Swiss people feel about that, quite honestly. But there's a little more faith in Credit Suisse right now. What else happened? This morning, the ECB raised rates 50 basis points, which is really a surprise to me. I mean, with the banking sector in crisis right now, you would think they would slow down, at least only 25, if not unchanged. I mean, the ECB, European Central Bank, has a single mandate, though, unlike the Fed. The Fed has a dual mandate of controlling inflation and financial stability, which they call, it's what they call it is price stability and maximum employment. That's their dual mandate. Really what that means is control inflation and make sure nothing crashes in the economy. The ECB, on the other hand, only has a single mandate, which is to control inflation. So, you know, maybe it makes sense that the ECB did 50 BPS raise, because if their goal is only to control inflation, you know, raising rates is what's going to do it. Even if it does cause a banking crisis, which looks like one is brewing. So, so I'm a bit surprised the ECB raised it 50 BPS. And it's going to scare people. It's going to scare people. And I mean, it's just, one thing that it does is that it signals that next week the Fed may raise rates. the Fed has a meeting on Wednesday, and the odds right now are that the Fed will probably raise rates 25 basis points, but they might leave them unchanged. Frankly, I think they have to leave them unchanged. I mean, you're creating a banking crisis. How do you raise rates into that? I don't know. But right now, the odds are that they're going to raise it 25 BPS, and that certainly looks more likely after the ECB raised it 50 BPS today. It looks like the Fed may do the same thing. Maybe they are that serious about fighting inflation that they're willing to take these hits in the banking sector. Raising it 50 BPS, and if the Fed raises it 25 BPS, it does signal a form of confidence in the banking system. Like, if they're willing to raise rates even though all this crap is occurring, it means they feel pretty safe in doing so. So it is sort of like a confidence signal. Okay, we can raise rates because we're not scared that bad things are happening. But bad things are happening. And every time something really bad is happening, you always get the same song and dance, the same prelude, the prodromo phase or whatever, prodomo phase or whatever you call it, before a crash, where everybody is saying nothing's wrong, but everybody knows that something is wrong. So I'm not sure confidence signaling is really the best move right now in the form of raising rates. You might want to just be honest and say, okay, there are some problems. We need to leave rates where they are, or maybe even pull them back a little. So the real problem right now, I think, and look, it's early in all of this banking crisis stuff, so we don't really know exactly what it is right now, but I think the main problem is that we've had multiple years of very, very easy money. Lots of money being pumped into the economy, and while that was happening, interest rates were at 0%. So you have all this money flooding into the economy while interest rates are at 0%. And what that does is it creates a lot of low interest loans. And anybody who's watching this probably has one of those loans. You've got a mortgage at 3%. People refinanced at 3%. Who knows how many businesses got loans that were at 3% or lower? There was just so much money floating around, and the interest rate was so low. All of these banks created long-term loans at these very low interest rates, right? But now, so on their books is a bunch of loans, say at 3%, so they're getting 3% interest off of their books, but now the interest rate is 5 or 6%, and there's inflation on top of that. Those loans that they're only getting 3% on are actually losing money in real terms. They're not keeping up with inflation, and any money that the bank borrows now, it borrows it at 5 or 6%. So it's earning money at 3%, but it's borrowing money and paying out at 5 or 6%. And a lot of banks are now in this situation where the money that's coming in is at an interest rate at very low prices from all of the easy money in the past few years, and they can't borrow money, they can't bring money in at a rate that's lower than that. So the business model is screwed up. The business model of we give out loans at a slightly higher interest rate than we actually pay. Right now, they're paying at a higher interest rate than the interest rate that they're taking in. I mean, that's the whole banking model, and it's flip-flopped now. So it's not a surprise that all of these banks are in trouble. And the main driver of all that is interest rates climbing. They can't change their 3% loans that they have on the books. Nobody's going to say, people have their rates locked in. There's no way they're going to say, okay, I'll pay you a higher interest rate. So banks' books are flip-flop now. So that's what we're seeing, and interest rates are causing it. Higher interest rates and inflation are eroding the value of all of the loans that were made during easy money times. Big problem. Big problem. I mean, this is how banks make money, you know? And it doesn't sound like a lot. All right, so, they're only taking in 3%, but they're paying 5%. I mean, that's not a big difference. But banks leverage this stuff up. Banks use leverage 10, 20, whatever, 50 times leverage. So those percentages get real big real fast when they leverage. So yeah, so when banks aren't making money with that, some of them start to fail, and then the snowball effects happen. You start to have the run on banks, which is psychology. That makes things worse. Some of those loans that they've given out at 3% are going to start failing, especially if there's a recession. Some of those loans are going to start to fail. All right, so not only are they only getting 3%, which isn't enough, some of those loans are crap. And if there's a recession, they're going to fail. So, the interest they're earning goes even lower because of the bad loans. So, yeah, so banks are in a position right now where they can't take in as much money. I mean, where the interest coming in just isn't enough to cover their costs of borrowing money. So the finance world right now is all flip-flopped, and interest rates are causing it. So you would think the Fed, wouldn't raise rates here. I mean, are we really going to make the problem worse by continuing to increase interest rates? If you want to destroy inflation, yeah, okay. But my feeling is that it's very clear right now that where interest rates is causing enough pain to take inflation down. We're at the pain point. So why keep going when we can just stay here, and where we're at is going to inflict enough pain to bring inflation down, right? When these banks start failing and money starts getting sucked out of the system because of those failures, inflation will naturally recede. But whatever, we'll see what the Fed does. I don't know. I'm not, I don't have a PhD in this stuff. So anyway, so what do I have? I've shorted I have the ARK and the coin puts, which are from last week, and they're worthless. I'm just leaving them there because there's no point in selling them. When an option is worth 1 cent, if you sell it, you got to pay commissions on it. So, I mean, you literally can't sell it. But, yeah. So, my active positions are, I have IWM puts, which is the Russell 2000 ETF, and I have KRE puts, which is the regional bank ETF. That's where the pain is located right now. Yeah, it's becoming clearer that that's where it is. Last week I had thought it was crypto because the first 3 banks that went under were crypto banks. I still think that's a really weird coincidence that the 3 first banks that went down, Silvergate, Signature, and Silicon Valley Bank, were all big crypto banks. So I figured, it can't be a coincidence. There must be a crypto problem here. I still think that's sort of true. It's very weird, but whatever. I'm going to concede that crypto doesn't seem to be the main problem here. The main problem is what I just explained, the interest rate flip-flop. These banks, aren't taking in enough interest for the interest they're paying out. So KRE is liquid. It's an ETF that focuses on smaller and regional banks. So that's sort of the center. I mean, somebody suggested to me just playing the individual banks, but they're not very liquid. If you buy options in them, the spreads are going to be huge. You're going to have a problem getting in and out of those positions. KRE is liquid. And honestly, it's not even that liquid, but it's liquid enough that you can get in and out of it easily. So stick with that to play the banks. Yeah, and IWM, that's the Russell 2000. These small and regional banks, they loan out to smaller companies, and the IWM is the Russell 2000, the small company index. So yeah, the smaller companies that get their loans from these regional banks, if the regional banks go under, they're going to be in a lot of trouble. So that's really where you want to be. You want to be in the banks, the regional banks, not the big banks. The big banks are going to be safe here, theoretically. I mean, it could spill over into them, but right now, the big banks look safe. So the big banks are very well regulated. They had a lot of guardrails on them, and money's going to be coming into them, so you don't really want to mess with the big banks. But you do want the smaller banks, and KRE is the smaller banks. They're the ones who have the interest rate problems. And then, yeah, IWM, the smaller companies that take in the money from these regional banks. That's really where you want to be. If you don't want to be in that, you can just do SPY. I mean, always, SPY is always a good play. It's the most liquid security out there. Well, maybe besides treasuries, but it's the most liquid equity out there. So yeah, that's where we're at. A lot of problems brewing. Now, with that said, with all these problems brewing, I don't want to say that we're about to crash. It's not going to happen today. It's pretty clear from what we see out there. It's not going to happen today. It's not going to happen right now. All right? These problems take time to snowball. Right now, what's happened is, it began with, Silvergate failing, and then SVB, and then Signature. Let's picture the snowball at the hill. We're still near the top of the hill, and the snowball is still pretty small, right? So, and it's rolling slowly. I don't see a good way for that to be stopped, especially if the Fed keeps raising rates. It's just going to speed up the snowball. It's just going to speed up the snowball. I can't understand why they would raise rates. But, yeah. So we're at the top of the hill. We're slowly spinning, going downward. There's not a whole lot that can be done to stop it, short of the Fed jumping in hard and intervening, which just isn't going to happen right here. Not with inflation where it's at. It wouldn't be politically viable. So I don't think anything's going to stop the snowball. But it's not at full steam yet, okay? The real money-making opportunity is when it gets to full power, giant snowball rolling down the hill at 100 miles an hour, ready to smash anything that gets in its way. We're not there yet. My best guess would be early April, mid-April is when we get to that full steam snowball, all right? Earnings season, Q1 earnings. January, February, March earnings are going to come out the second week of April, the third week of April, and the fourth week of April, all right? When those are, and the first set of earnings in the second week of April is the banks. The banks report first during earnings season. So that second week of April is when the banks are going to report. That's probably when the snowball will be at full steam. It might happen slightly before that, as the market anticipates the banks reporting and how ugly it might be, and how they begin to say this narrative of our business model isn't working. Maybe the market anticipates that, or maybe there's some more failures before then. But I would say the second week in April, when the banks report, is the best guess of when things might really get ugly. All right? Yeah, that would be my best guess. But you want to have something on until then, in case there's more failures and more crashes, and We might even just sort of bleed lower slowly until then. So you don't want to have nothing here. So yeah, but the second week in April seems like the safest bet as to when things really get weird. All right, that's the deal today. Time for pizza. Nothing to hide.